other credits that may grant you additional tax benefits. So usually when my clients' backs are against the wall and we're looking for more ways to save on taxes, these are the three primary areas we evaluate to see if we can create more tax savings for them. And in some cases, we might look at certain charitable giving strategies, but that may not apply to everyone in this video, so I will save that for another episode, so be sure to subscribe. If you enjoyed this video, make sure you click the like button to help this reach more people, and drop a comment below. I sincerely appreciate your positive feedback. And if you need
What's going on, y'all? What's going on?
Your taxes, just apply to work with one of my CPAs today at mycpacoach.com.
Hope everybody having a good day. Y'all lie. Hope everybody having a good day, man.
But what if I told you that you can instantly reduce your taxes by simply taking money that you already have and moving it into an investment that you already need?
Right now, I'm finna finish off what I got going on as far as the tongue part of my tattoo. Just adding the color and everything. And then I pretty much be done as far as right now. And I just kind of want to let everything heal just to see how everything go. And we'll see if I need to touch up anything or fix anything from there. Okay, this is something I also want to check. Because apparently I am supposedly... So I am live right now on Twitch. Okay, cool. Okay, that's that. Done. Now the only thing I wonder is why my streams don't save to my page. I don't know. That's crazy. But I am live on Twitch, so I'll take it. I'm live on Twitch. Let's see what kicks on out. I am live on Kick. You must have made that flyer. It's crazy. No, I have not made it yet. Can I just finish this little part right here? Can I? Do you mind? Oh, snap. I just want to finish this little part here and then back to business. I'm also watching a video right now learning about tax. You know what I'm saying? Write offs and stuff like that. I'm not just sitting here playing with myself. I am actually learning some shit while tattooing myself. I'm just trying to finish up my tattoo, bro. Just let me do this. I promise I will make the flyer. I promise you I will. It's echoing. What? It shouldn't be doing that. about now? Is it still echoing?
Today, business happens virtually everywhere. That's why you need Supermobile from T-Mobile. In moments of high demand, T-Mobile's network adapts. Put your business connection first. Supermobile, the best business plan on the best network. Welcome to Snack Factory. Here, we rethink pretzels. These are the new Snack Factory poppers.
Is it still echoing?
See for yourself in our weightless tasting room.
See, if you gonna give me some updates, at least respond when I'm asking a question so I can know what I'm doing here.
A lot of people do not know this, but the tax code literally grants you tax deductions for making certain types of investments. And we call them tax deductible investments, which allows you to do two things. Number one, build wealth. And number two, reduce your taxes all at the same time. And as a licensed CPA at mycpacoach.com, I have personally saved my clients 6 to 7 figures in taxes by simply taking advantage of the investments that you are going to learn in this video. So go ahead and save this video, comment below if you have any questions, and make sure you subscribe for more guidance to less stress and lower taxes. All right, so as we go through this, remember, your tax is solely based on your income. Your tax rate increases as you earn more and more income. But when you make tax deductible investments, you are pushing income off of your tax return for this year. For example, let's say that you earn $100,000 in income and made a tax deductible investment of $20,000, making the entire amount tax deductible. Well, in that case, that $20,000 investment will lower your taxable income to just $80,000, which would save you $4,400 in taxes if you were in a 22% tax bracket. Now, the more income you earn, the higher your tax rate will be. And therefore, the more beneficial these tax deductions will be for you in those scenarios. For example, a $20,000 tax deduction will save someone in a 37% tax bracket about $7,400 in taxes. So as you can see, your tax savings will depend on your income and your tax bracket. Now, with that said, let's go through the various types of tax deductible investments, starting with the very easy ones, and then we will gradually get into some bigger investment opportunities and types. So let's jump in. Investment number one, your traditional IRA. Now, if you don't know, an IRA simply stands for an individual retirement account. And the good news is that literally anyone can set this up at a brokerage for free, typically at a place like Fidelity, Vanguard, TD Ameritrade, and so on, as long as they have earned income. Now, let me be clear, this does not have to be done through a job, an employer, or a business. An IRA is an individual account that you can set up yourself. So here's how it works. Right now, you can contribute up to $7,000 to a traditional IRA or $8,000 if you're above the age of 50. And when you do, you will receive a tax deduction for it if you qualify. And this is per person. So if you have a spouse, that person may also be able to get another $7,000 to $8,000 into their account. You can even set this stuff up for your kids, and again, that's another $7,000 if that child has earned income. Then once you have these accounts, you can also invest into various assets like stocks, bonds, CDs, and other assets to build up wealth until the point in which you retire. And as those investments grow in value, you would pay no tax on them. You can even buy and sell investments in these accounts, and it still will not trigger a tax bill. You would only pay tax when you start taking money from these accounts, which you can start doing once you turn 59 and a half if you choose to do do so. So if you are in a high tax bracket today, expect to be in a lower tax bracket when you retire, you will instantly reduce your taxes by moving funds into a traditional IRA. Now, there is one big caveat to this, and that is that your deduction can be limited or disallowed if you are covered by a workplace retirement plan, such as a 401k, for example. For instance, single taxpayers with incomes above $87,000 and married filers with incomes above $143,000 will receive no tax deduction if they are covered by a retirement plan at work. So be sure to consider your income, your 401k benefits before setting something like this up. Speaking of 401ks, this actually perfectly leads us to the next big tax deductible investment here, which is number two, your traditional 401k. So a 401k is very similar to an IRA. So the 401k is set up for a business. It has much higher contribution limits, which means greater tax deductions, and more importantly, lower taxes. You can take advantage of a 401k plan through your employer, or even better if you have a trade or business, because you can set one of these up through that as well for even more tax benefits. So here is how a traditional 401k works. As an employee, you can put up to about $23,500 of your wages, or $31,000 if you're over the age of 50, into a traditional 401k account. And thanks to the Secure 2.0 Act, taxpayers between the ages of 60 and 63 can put up to about $35,000 of their income into a traditional 401k. Now, regardless of the amount that you decide here, because all this is voluntary, what you need to understand is that once you put money into a traditional 401k, you are creating a tax deduction that is equal to the amount that you put in it. Or in other words, you pay no tax on that portion of your income. You're instantly reducing the income that would otherwise appear on your tax return for that year. And by the way, that's just the employee side. Then the employer could also add up to another $46,000 or so towards your retirement account in 2025, depending on how their plan is designed, which they would be able to deduct. But that also means that if you operate your own trade or business, even if it's just a side gig, then you can also take advantage of that same employer contribution limit. For example, you can set up a solo 401k or SEP IRA for your business, which would allow you to put up to 25% of your business income towards your retirement as an employer up to this limit, which would only reduce your taxes even more here. Now, that said, regardless of the number and the amount and types of 401ks that you use, they all share the same maximum employee limit and the maximum employer limit. So if we added both of these limits together, the maximum that any individual could put towards their own 401k for 2025 is as follows: $70,000 for individuals under the age of 50, $77,500 for people over the age of 50, or about $81,000 for individuals between the ages of 60 and 63. Remember, this is per person. So if you have a spouse, then they would have the same opportunity to use these same limits to create even more tax savings on your tax return. Now let's talk about something else. Number three, health savings account. Now, a health savings account, or HSA, is another account where you would receive a tax deduction in exchange for putting money into it. But unlike retirement accounts, you can actually spend the money in this account on.
Be there right when they need you. Money received directly in your bank account. When it counts. Zelle. We raise your sad coffee. Sonic's $2.99 salted caramel toffee iced coffee.
On qualified health expenses that you may already pay for. So, like doctor visits, dental visits, chiropractic care, and even massages, and so much more. So, this is how it works. If you qualify, you can put anywhere from $4,300 to $8,500 into an HSA, depending on your filing status, whether you're single or married. And when you do, three things happen. Number one, you will get a tax deduction for the amount that you put in your HSA. And number two, like we mentioned, you can invest these funds in your HSA into other assets, like stocks or bonds. And number three, you can spend your HSA funds on qualified health expenses. And when you do so, those funds come out tax-free. So if you use your HSA correctly, you can effectively never pay tax on the money that you put inside that account. Now let's cover one more type of investment account that you can use to reduce your taxes, and then we're going to level this up here and get to some more advanced stuff. Number 4, donor advised funds. So if you already give money to charity, or you plan to, then you can supercharge your charitable tax deductions by investing into a donor advised fund. Now, this is basically like a piggy bank to fund your future charitable giving, like a savings account. And you can easily set something like this up for free at Fidelity. So here's how it works. In general, when you give money to any charity or registered nonprofit, you receive a tax deduction in the year that that charity received your donation. But when you move money into a donor advised fund, you will receive an immediate tax deduction based on your contribution, not when the charity receives it from that donor advised fund. So in essence, you can move a large lump sum of money into a donor advised fund to create a massive tax deduction in this tax year, and then you could choose to give the money in that fund to charities over whichever period of time that you would like, whether that be in 5, 10, 15, or however many years. Now, in addition to that, you can invest the funds in this account to grow the balance over that period of time as well. Now, while the amount that you move into a donor advised fund is eligible for a charitable tax deduction, please keep in mind that donations like this are considered itemized tax deductions, and most people take the standard deduction by default on their tax return. So typically, in order for something like this to make sense, you would need to already be taking the itemized tax deduction on your tax return, meaning it is already more beneficial than the standard deduction for you, or you're planning to move such a large amount of money into your donor advised fund, so large that you end up qualifying for the itemized tax deduction anyway. And lastly, please keep in mind that because this is a charitable account, the money must go to charities. You cannot use it for any other purpose once you deposit funds in it. All right, so now that we've covered some of these simple account structures that will give you a tax deduction for simply moving money into it, now let's get into some specific assets that provide even larger tax deductions. Number 5, a small business. So not only is owning a small business one of the fastest ways to build wealth, but it is also one of the best ways to reduce your taxes. And this is because business owners have the ability to pay taxes after deducting all of their expenses, whereas most people pay their taxes first and use whatever is left to pay for their lifestyle expenses. But by deducting expenses first, business owners are able to report less income and consequently pay less taxes. And the tax law allows business owners to essentially write off almost anything as long as it has a business purpose. You can write off a portion of your mortgage, your rent, your utilities, vehicles, food, health expenses, travel, and so many other expenses as long as there is a business purpose associated with it. Plus, the tax law even allows you to write off the expenses that you incur to start and grow your business. The IRS allows you to write off your startup costs, your legal costs, advertising expenses, research and development costs, and so much more. These tax deductions can result in tens of thousands of dollars in tax savings alone. But if that's not your cup of tea, let's move on to number 6, short-term rental properties. Now, real estate is widely known as one of the best tax shelters in the world. You can qualify for very large tax deductions when you buy real estate, and you can even avoid taxes when you sell your real estate. Plus, on top of all of that, the tax deductions can be so large that it offsets other income on your tax return, like your W-2s or business income. And that is why so many people choose to invest into specifically short-term rental properties to instantly reduce their taxes. Because unlike other types of rental properties, tax deductions and losses associated with short-term rental properties qualify as a business activity, which is a key distinction here that allows your deductions and losses to offset other income, like your business or W-2 income on your return. Okay, then, so how does the IRS define a short-term rental property, and where exactly do these deductions and losses actually come from? Let's go ahead and break this down. So the IRS defines a property as a short-term rental when the average period of time that a guest stays there is 7 days or less. It's that simple. And as far as deductions go, there are several when it comes to real estate, but the biggest one is depreciation. This is a non-cash expense that allows you to write off a portion of your property costs each year, sometimes allowing investors to write off literally 20 to 30% of their property in 1 year, depending on how they choose to take depreciation. depreciation. But in addition to that, because these types of rental properties are treated as businesses, you are also able to deduct all expenses connected to these rental properties, such as the mortgage interest, property tax, insurance premiums, utilities, repairs, and many other expenses if they are incurred to conduct your real estate trade or business. And because of all of these deductions and depreciation, real estate investors are often able to report losses on their tax returns despite earning rental income from their tenants. Number 7, long-term rental properties. Now, long-term rental properties technically have the same ability to enjoy all of the tax deductions that we just covered. However, there is one key difference. Rental income from long-term rental properties are generally considered passive activities, not business activities, which is a key here because passive losses and deductions can only offset other passive income. And once these deductions offset all of your passive income, generally only $3,000 of your remaining losses can be used to offset other income you have from your business or from your employer, unless you meet certain criteria. And that criteria is either A, qualifying as a real estate professional, which is simply a time requirement for the most part. You don't need a license or real estate certificate for this at all. You just have to work at least 750 hours in real estate activities in which you materially participate in, which comes down to be like 10 to 15 hours per week. And then most of the services you personally perform must be in real estate as well. Now, if you do not meet this requirement, you can also qualify your rental property as a business activity if the property is used for a business you own, like an office, a warehouse, or something that is being used for a.
I checked Allstate first, saved hundreds on my car insurance. Unfortunately, I didn't check to see if anyone was watching before I stole cotton candy from a child. Well, at least I checked Allstate first and saved hundreds.
Same thing?
This is our year.
You know, if getting AT&T's best deal taught me anything, it's that switching things up can be a good call.
Get the all-new iPhone 17 Pro on us, designed to be the most powerful iPhone yet. Most expensive plan not required.
Or a business that you are a part of. But if none of this is possible, then you can still significantly benefit from your long-term rental properties in the sense that it will at least limit your passive income. But if you want more tax benefits, consider a short-term rental business or this next investment opportunity here. Number 8, oil and gas investments. Now, this is something that has very large tax benefits that simply is not talked about enough. You can invest money into a private oil and gas company and write off 65 to 85% of your investment in the first year. Now, oil and gas is used in so many ways here on a daily basis, from fueling our vehicles to heating our homes. And when you make an investment into an oil and gas company that conducts drilling, you get 2 huge tax benefits. Number 1, similar to real estate, oil and gas companies are able to take very large amounts of depreciation, which creates a massive tax deduction for them. And number 2, this tax deduction automatically qualifies as a business activity and can easily offset other income on your tax return. So in some ways, the tax benefits of oil and gas are even better than real estate. Because as you saw here, in order for real estate losses to offset other income on your return, you have to be highly involved in the day-to-day operations and meet very specific requirements. Whereas with oil and gas investments, you do not have to be involved in the day-to-day operations at all and do not have to meet very specific requirements for your deduction to offset other income on your tax return, like real estate. But to be clear here, the type of oil and gas investments we're talking about are not stock investments on the public stock exchange. These are typically private partnerships that conduct drilling operations and allow investors to invest as general partners in their business. And because of the nature of this, these investment opportunities are typically limited to accredited investors. Now, I have separate videos that go more in depth into every single investment strategy that we've covered so far, so be sure to subscribe to our channel if you want to learn more. And if you want a tax plan that is guaranteed to reduce your taxes, just go to mycpacoach.com to apply to work with one of my CPAs today. Stop. You do not want to file taxes for your business, your 1099 gig, or your side hustle without watching this full episode. You are about to find some of the biggest tax write-offs that you can use to literally reduce your taxes within a few minutes here. As a licensed CPA, I can tell you the number one reason why 90% of people overpay their taxes is because they miss one big thing: tax write-offs. I see it over and over again. There are things that you are probably already paying for, but simply not writing off, like portions of your home expenses, car expenses, health expenses, your children, and so much more. And these are things that all can be legitimately written off through your business to help you pay less taxes. So, as someone who helps people do this every day at mycpacoach.com, I want to share with you the top 15 tax write-offs that can help you save big money in taxes. So let's jump right in. All right, let's start by giving you an immediate 20% tax write-off against all of your business income with number one, the QBI deduction. Now, this is a freebie tax deduction that grants you a 20% write-off for simply being classified as a business owner, even if your trade or business is unincorporated. For example, someone with $100,000 in business income will be able to write off about $20,000 off of their income and only pay tax on the remaining $8,000, which would save someone almost $5,000 in taxes and a 24% tax bracket. Now, you can take this deduction as a S corporation, partnership, sole proprietorship, or as an LLC taxed as any one of those classifications. And guess what? You automatically qualify for this deduction if you earn less than about $192,000 as a single taxpayer or less than about $384,000 with a spouse. But this tax deduction is not automatically applied to your tax return. And I see so many people miss this easy tax write-off when they actually qualify for it. So make sure that you or your CPA does not miss this very easy write-off. Now, if you happen to earn above the threshold amounts that I just shared with you, then you may still qualify for this deduction, but there are some more strict requirements that relate to the type of trade or business you have as it relates to you qualifying for it. For example, certain service-based businesses do not qualify for the QBI deduction when they earn income above the thresholds. But there is some nuance to this, so if you want to learn more about this, just drop a comment for me below. That said, let's make sure that you do not miss one of the largest tax deductions in the history of the tax code with write-off number two, depreciation. Now, depreciation is one of the best tax write-offs because the tax law allows you to expense it on your tax return, but it actually costs you no money out of your pocket. This is simply an additional tax write-off against any business property or assets that you already own. So think about things like any equipment, tools, machinery, furniture, computers, cameras, even buildings, vehicles, and more. Now, by default, these types of purchases are treated as assets, not tax-deductible expenses. However, depreciation allows us to write off portions of these assets every single year. For example, let's say that you are a photographer and own a $10,000 camera, and the tax code says that this camera is considered 5-year property. Well, in this case, you will be able to write off $2,000 of the amount of that camera each year for the next 5 years. But to be honest, that's just the basics. That's level one when we talk about depreciation. There are many more ways that you can calculate it. In some ways, even allow you to write off up to 100% of the property value in one given year. For example, in the same exact scenario we just went over, if you use a depreciation method called Section 179, then you will be able to expense the full cost of that camera in one given year. And that would give you a $10,000 tax write-off, saving you about $2,400 in taxes if you were in just a 24% tax bracket. And that's just one additional type of depreciation, by the way. There's bonus depreciation, double declining balance depreciation, and many other forms that may be beneficial to you when filing your tax return. So make sure you become familiar with it, or ideally the person you file with is, so that you can avoid paying taxes. And bonus depreciation specifically is something that you can use with our next big tax write-off here. So let's go ahead and talk about write-off number three, the vehicle tax deduction. All right, so look, even if your car is in your personal name, you can write off the business use of it under your business. Therefore, if you use your vehicle in any way for your business, you can write off the portion of that use that is applicable to your trade or business. So whether you use it 100% of the time for your business or just 5% of the time for your business, you can typically write off that business use percentage with the actual expense method. For example, let's say you have $20,000 in car expenses for things like gas, oil, tires, repair and maintenance, insurance costs, licenses, and so on. And let's say you use your vehicle 50% of the time for your business. Well, in that case, you would typically be able to write off $10,000 of those expenses on your business tax return. Plus, you will also be able to write off some of the depreciation of that vehicle as well, which again will allow you to write off some of the purchase price of that vehicle every single year until it is fully expensed out. So let's say that you have a vehicle that is a 6,000-pound SUV that you bought for $60,000 in 2024. Well, under normal depreciation, you could write off about $12,000 per year. But with the bonus depreciation tax provision, you would actually be able to write off up to 60% of that same vehicle in 1 year, now giving you a $36,000 depreciation write-off instead of $12,000. So now instead of having just $20,000 in vehicle expenses, you have $56,000 in expenses, giving you about a $28,000 tax write-off that can be used on your tax return in this scenario, which would save someone about $7,000 in federal tax alone who is in the 24% tax bracket. Now, at the time of this video, bonus depreciation has been phasing out each tax year here. It is currently set to be 40% in 2025, 20% in 2026, and 0% in 2027. However, there is an expectation that the Trump administration will increase these rates. So to stay in the loop, just make sure that you are subscribed to our channel. Now, outside of writing off your actual car expenses, you can alternatively take something called the standard mileage deduction instead, which for some people may actually be more beneficial. So in 2025, this method will grant you a 70 cents deduction per business mile that you drive, or a $700 deduction per 1,000 miles that you drive for your business. With that said, let's go ahead and park this car in the garage and talk about writing off a big portion of one of your other largest expenses, your housing. And we're going to do this with write-off number 4, the home office deduction. So if you have any space in your personal residence that is exclusively used to work on your trade or business, then you likely qualify to take the home office deduction. Now, this deduction allows you to write off a portion of your total home expenses under your business. And those expenses may include your rent or mortgage interest, your property taxes, homeowner's insurance, utilities, Wi-Fi, repairs, HOA fees, and depreciation, which we've already talked a lot about. So for example, let's say you have $100,000 in total home expenses and use 10% of your home for your business. Well, in that case, you could write off $10,000 of those home expenses with the home office deduction and save thousands of dollars in taxes. Now, in order to qualify for this deduction, you must have space in your home that is exclusively used for your business. Or in other words, the space should not be used for any personal purpose. Now, examples of this in the real world may include office space in your home to work on your business, even if it's just administrative tasks, or if you use your home to store inventory, like in a garage or basement or something related to that, then that space will also qualify for this deduction. But the bottom line here is that if you use any space in your home exclusively for your business, then that space could be included as part of your home office deduction. But outside of that, sometimes business requires us to travel. So let's talk about write-off number 5, the business travel deduction. So if you conduct any business during your travel, the sum of your travel expenses may be tax deductible through your business. The key here is to make sure that there is a legitimate business purpose for the travel expense. For example, let's say you spent $5,000 to go to the Bahamas with your family, which includes the cost of your airfare, lodging, and transportation expenses. Well, if you conduct no business there, then none of that expense would be tax deductible for you at all. But let's say instead the travel was for a board meeting or a business event. And let's also say that your family just so happens to be involved in your business as well. Well, in that case, you may be able to write off the full $5,000 travel expense under your business as long as there was substantial business activity conducted during each day of that business trip. So the moral of the story here is if you want to pay less taxes, stop going on vacations and start going on business trips. Now let's talk about another big tax write-off that sometimes can go hand in hand with business travel. Let's talk about writing off your dining expenses with write-off number 6, the business meals deduction. So look, if you incur meal expenses while discussing business, then your meal expenses may be tax deductible for you under your business. All you have to do is enjoy these meals with a business contact and discuss a business topic. It's really that simple. And then you can deduct your dining expenses at restaurants. Or if you're having your meals catered or delivered to you, like using DoorDash or Uber Eats or something, then you may also write off those meal expenses as long as the meal qualifies as a business meal. So, for example, let's say you have $15,000 in meal expenses. Well, if there's no business contact present, and there's no business purpose for the meal, then it's simply not tax deductible. But let's say instead these meals are with one of your business partners, employees, board members, or clients. Well, in that case, the expense would be tax deductible as long as there is a legitimate business discussion taking place during that meal. Now, usually meals like this are 50% tax deductible, which in this case would allow the taxpayer in the example to write off $7,500 of their meal expenses on their business tax return. So if you're not already writing off meal expenses like this, then you may want to look into ways to qualify your meal expenses to meet the criteria of the business meals deduction and reduce your taxes. Now let's switch gears here and talk about another large expense for millions of people, healthcare, and how you can write off a large portion of these expenses with write-off number 7, the health insurance premiums deduction. So if you have health insurance and pay any portion of it, then the amount you pay can be tax deductible for you under your business. And so many people miss this easy tax write-off because they do not know that Section 162 of the tax code allows self-employed individuals to write off their health insurance premiums. It allows you to write off the full value of the premium, which may also include your spouse or children if they are also covered under the policy. So if your entire family was covered by a health insurance plan that costs you $24,000 per year, then you will be able to write off 100% of that $24,000 health insurance premium. Now, how you actually go about writing these types of expenses off will ultimately depend on your business entity because there are different rules for different types of entities. But on the highest level, your premiums are generally tax deductible. But outside of just health insurance, some people have very large out-of-pocket medical expenses. Well, now I'm going to show you how you could write those off under your business as well with the use of write-off number 8, a medical reimbursement plan.
Alright, certain parts of it do look a little crazy.
Okay.
Like certain parts of it do look a little crazy, but it's also healing. So you gotta keep in mind, like if it's healing, you're going through a lot right now.
It's complicated.
But,
USAA, become a member today.
and a good bit of it is already healed from when I did it before. So, okay, I think I went crazy on the tongue. It's crazy.
You've got a big neck, and you need to smell fresh. That's why the all-new
Just gonna let everything heal, man. Other than that, we all done. I appreciate everybody for watching. Let me get off this thing and do some other things as far as creating like a special and stuff. I'm coming out with a special pretty soon. Quarter sleeve, half sleeves, medium tattoos, large tattoos, and smalls. So if y'all want to get in on them deals, catch them specials, make sure y'all follow me on all my social medias. You know what I'm saying? Tap in. And yeah. Make sure y'all follow me on everything at Also Amazing on all platforms. And Also Amazing Jayy. You know what I'm saying? So appreciate everybody for watching. I'm finna get out this live so I can get the business. Y'all be safe. Get y'all money up. You know what I'm saying? And we out of here, bro. I'm gonna keep y'all updated on the healing process and everything like that. Appreciate y'all. Y'all be safe.